Hello, welcome to Two Founders, your friendly chat about startups. I'm Anna Nilsson, and this is my co-host, Matteo Getti.
Hi, everyone.
So, are we entering a new era of company structure, mission first? So far, everybody's going for profit, but is that dying? Should we do another company structure? Out with profit, in with mission.
And I'll talk about when to invest in infrastructure. We have use cases from both scenarios. So when actually makes sense and when does not make sense.
The idea of shareholder primacy was supposed to be good for investors, but we're now in the era of extraction primacy, where this thing is starting to eat its own tail. Companies are being hollowed out and value is being destroyed. And I think when we all wake up to this, it's going to be very easy, actually, to just decide, let's have mission primacy.
So that was a clip from Eric Ries. So he's talking about a new era of organization structure where he is calling a quits to profit first, and he is advocating for a mission first organizational structure. And I'm going to tell you a little bit about what that is. But first, who is Eric Ries? I think everybody knows who he is without maybe knowing his name. He's the author of The Lean Startup, which if you studied computer science after 2010, you have read or heard about this book, or you are currently working in a structure based on the lean startup. So he studied computer science back in the day, and then he founded a couple of startups, and eventually he joined IMVU, where he learned about customer-focused, customer-centric development, and he developed this lean startup method, which you create an MVP first, and then you try it out with the customers, and you work in this iterative way.
Yeah, kind of like used in most of the accelerators, right, we have been through. So
Yes. So he wrote this book 2011, and it's shocking now that that was so late, I suppose, because I don't think there's any company that doesn't work in the lean way.
correct.
So 15 years ago, he created a way to produce products that work, that make sense. But now he notices that these products are going adrift. So Eric Ries argues that the current structure we're putting on companies is going to change, that the only way to create companies going forward is with this mission first strategy. And I'll tell you what I'll think about it eventually. He wrote this book, Uncorruptible, Why Good Companies Go Bad and Great Companies Continue to Be Good. Now I said the title in the wrong way, but it's approximately like that. And the whole point of the book is that as long as you don't focus on your mission, the company will go corrupt.
Does it have examples of which companies went corrupt?
Yes. So, as one example, he's talking about Philip Morris International. It's a tobacco company. He gives this as an example that some companies, even though they make profit, they don't necessarily make good for the world.
The Philip Morris International is not profitable. Yes, they make net income, like I think $9 billion a year, but they create $600 billion a year of costs that they don't have to pay for in the US alone.
So even though the company makes 9 billion, it costs a massive amount for society that this company even exists. And this makes me think about fashion companies where all the clothes we wear, when we throw them out, somebody has to take care of them. And if we buy cotton or linen or these kind of fabrics, they're very easily to reuse them or to make them go back to the earth in a natural state. They don't create that much byproduct. But polyester and other plastic materials are really, really difficult to reuse and take care of, and most of the time they just end up in a huge mountain of trash. This is very expensive for society, but the companies sell those t-shirts cheaper than the full cotton ones. So it's this, even though a company makes profit, it doesn't mean that the world around it makes profit. And I don't know if this is the concern of the company, but it is, I think that this argument is interesting in that sense that, okay, what is profit? What is valuable? And should we actually have companies that don't create value for everyone in a sense, or at least don't remove value for others?
That is a really cool concept.
So he goes now into the example of AI companies. So I haven't double checked this, but Eric Ries states that all the big AI companies all have some sort of restriction on their company structure today. And I didn't go completely into it, but he specifically talks about Anthropic. So they are founded by some people that left OpenAI after they got upset about how OpenAI handled going into the market. So they created their own company. So just a little bit of background on Anthropic. It's the company behind Claude AI. They were created 2021, and their company structure, they have a public benefit corporation. So in that company structure, you're kind of forced to do something that is good for the public. But Eric Ries still says that that's not enough. So what they have additionally is a long-term benefit trust where 5 trustees have the power to put brakes and say, this is dangerous.
Is this something that Anthropic has today?
This is something Anthropic has today.
Oh, that's cool.
So they have built this into their company structure. And they have a bylaw in their company that states that any investment that they take in has to abide by these rules. I'm questioning a little bit, okay, what does this actually mean? Is this true? Because I saw that they had 4 billion investment in funding from Amazon and 4 billion from Google. And so they are paying their cloud services to a huge extent. And my question is, okay, sure, they signed this thing, but if they remove their funding, what can Anthropic do? I don't know. That's just a little bit behind AI. And then I heard this statement that most of our fears about AI is actually fears about capitalism. It's from a sci-fi writer, Ted Chiang. I think it has a heaviness to it. I think that this mission first idea is interesting, but how would you do such a thing, right? So Eric Ries, he puts it on each person alone or each company. He thinks,
rather than have a policy argument about what organizations should be allowed to do, which that's important, we have plenty of that, we have far too little discussion of what we as leaders ought to want to do. And the answer to that question is we ought to want to build companies and organizations that are incorruptible.
And I mean, this is a lovely sentiment, right? You ought to want to do good, but I don't like this kind of statement. It's like saying, here is how the world should be, but let's leave it to everyone to decide on their own to do what's good for the world. I don't know if I believe in that much. So Eric Ries states that it is also economically beneficial to follow mission-first strategy. But I don't know if this works for every company. Like right now we have this boom and this fear about AI, but would every company want to do mission first? He thinks that they want to because it has proven that if you just focus on profit, you will eventually kill yourself from the pursuit of profit. But I don't know, can you get investors if profit is not the main goal?
I feel not anti, but slightly different from what one is told in the startup world, right? You want to always chase the next round, increase I mean, it is your duty. You're legally pushed to actually increase the value of the stocks. So it is definitely a new concept. Also, now you mentioned Anthropic. I mean, Anthropic is arguably one of the top 10, maybe top even company in the world by capitalization. I'm not going to say it's easy for them, but it's definitely easier for them to have an ethical committee. Now I'm thinking about an early stage startup that should have when should you put in place an ethical committee, basically? Should it be profitable first or have a committee first?
No, you have to found it when you found the company. And that's what Anthropic did. So he states that when they were new, when they were just tech startup founders, they put this in place themselves at the step one. But I think that's unfair because they came directly from OpenAI. They're not just any type of startup founders.
Yeah, that was you already have like the unicorn experience kind of. And then you already know you're going to raise a lot of capital just by your pedigree. So it's slightly unfair to, I don't know, pick a random startup from, I don't know, Germany or from Sweden or from Italy, right? They won't have that degree of capital.
Yeah, and I think It's an interesting concept, maybe, but there are so many questions in it. Okay, imagine you have these checks and balances, this mission first. Where do you get a committee? So if we started a company today, who would want to be on our committee? And of course, you want to be in the AI committee, maybe, but they are not bound to the profit of that company at all.
Okay, so they don't take shares on the company, this committee, right? And they are there to the best of the ethical, right?
Yeah.
They're there to ensure the ethics. Okay, I'm understanding it a bit more, right? Is like, but how do they interact with the shareholders, this committee?
So I'm not an expert. The way I understand it is you have investors, you have a CEO, and they make decisions and they drive the company forward. But the point of the trustee, the committee, is to put brakes on decisions that they think is dangerous. So they're more analyzing decisions being made and have the power to stop things.
Okay, this reminds me, maybe wrongly, but this reminds me a bit of the quality of food in schools, right? That they say, hey, we have to go with the cheaper food because we don't have budget. But that eventually creates more health issues in kids that would cost to the state way more in the long term. So I kind of understand it, but then now we're doing it instead to individuals with companies. And it is definitely a shift. I'm glad that there is at least one example. Is there any other company that he mentioned that is doing it successfully, except Anthropic?
Well, I haven't read his book, right? So I'm a bit in a deep water, but I see that this is actually a trend right now because I think that we are coming out from an era where huge companies, they grew up in the early 2000s, like Facebook, YouTube, Twitter. Lately, we have this concept of enshittification, where people stop logging in because there's so many advertisements and just annoying things where the shareholders, they want to take out their money from the company. And this is actually devaluing their companies or making users not like them as much. So that's one part of the equation. So I think that he's right in this picture. Like there is something in it. And then also, as you know, recently read The 7 Rules of Trust with Jimmy Wales, the founder of Wikipedia. And he is stating exactly the same thing. And nobody can argue with how great Wikipedia is going. It's a huge organization. It's one of the most trusted sources on the internet. So I'm just gonna read. I prepared. So chapter 3 in his book, the rule number 3. A strong, clear, positive purpose is essential for people to work together and make something wonderful. So Wikipedia has a couple of fundamental principles. And the very first fundamental principle is Wikipedia is an encyclopedia. So if this is not mission first, I don't know what is, right? And I think they're a pretty successful organization. But then if you can actually call them
They're not profit, right?
They're non-profit. So I don't know exactly. But Jimmy Wales came out with this book in October. Now Eric Ries comes up with this other book. He just came out with it this May. So it seems to be something in the works of this, like, let's move away from profit and let's go into mission. So it's just a trend that I've seen, and I think it's super interesting.
So this news caught my eye from CNBC, where Mistral, that is a French company, or Mistral AI, that developed its own LLM. It was founded in 2023, I believe, from AI engineers of Meta and DeepMind. So really great thoughts and great minds. They are currently valued around $11 billion or like $15 billion. And last year they got a $1.5 billion investment from a microchip company, a Danish microchip company, ASML. And the news that sparkled right now a bit of a debate all over the internet is that the founder, Arthur Mensch, said that they want to design their own microchips since they have like this LLM model, right, to cut down costs. They already invested almost $1 billion in a data center in Sweden and Paris. And it seems they want to invest another $1 billion in this designing microchips. And what caused the debate is, but does Mistral have this much capital when their revenue is kind of like just $1 billion, right? So is they're investing more than what they're making into this design and infrastructure. So is it a good strategy in the long term?
Sounds risky, right? To
It sounds extremely
invest
risky.
in something that it sounds like it exists to some extent. But is it super specialized, these microchips, or something
Well, they don't want to
extremely...
depend on Nvidia, right? I guess like every other LLM that now right, in the gold rush, the one making money is the one selling shovels. So it's Nvidia in this case, the one selling shovels and GPU and microprocessors. So they want to have their own base. I'm going to tell you why I think it's a great move, actually. And I have other examples. I guess you're familiar with Snapchat, right? Founded in 2011, basically social media trying to compete with Facebook for several years. They did an IPO in 2017 and their worth was $3 billion. So by all account and purposes, Evan Spiegel, the co-founder, made it, right? 3 times as much as a unicorn. Shareholders should have been happy, and they competed against Facebook. Though the public investors and shareholders got hold on their expenses. And out of a 3 billion valuation, so mind you, 3 billion valuation, 2 billion were reserved to pay Google Cloud over a span of 5 years. And what that meant is that after all that scrutiny, they tried for several years to go away from Google Cloud, but they simply cannot. And the New York Times did an investigation on it that right now, Snapchat, at least back then, they had over 1 trillion media files spread over Google Cloud and AWS. So a migration of it would take so much capital that no investor would fund it, right? You cannot, it's the typical, right? You cannot just go to VC money and ask like, hey, please, can you give me VC money? Not to keep going with my PMF, right? With my revenue that is going well and increase revenue. No. It is to invest it in infrastructure with almost no marginals and to just migrate and maybe eventually save some costs. There is no VC in the world that's going to say yes.
Yeah, I mean, that's interesting. Like, you can take VC money to pretty much do technical depth, right? That's maybe not even in theory, that's not even investing in infrastructure. That's just technical depth. That's fixing something you should have fixed in the past.
In the past, exactly, correctly. So right now, as of today, I actually was checking. Still, today, Snapchat is negotiating hard with AWS and Google Cloud, but they're still in it. So they did not escape the infrastructure trap, is so we want to call it. So they are into this 2 billion trap, right? If you want to label it like that. And I have another couple of examples. So basically, Snapchat only focused on what they tell you, right? Focus on PMF, focus on what works, focus on money. They did, and now they are tied in infrastructure and they've been criticized for it. I have another example with the company called Zynga. Are you familiar with it?
No.
No, I don't expect anyone to be familiar with it until I mention Farmville. It was one of the first mini games on Facebook, and they were the one behind it, and they saw how this was in 2011 when they actually saw that they were tied to AWS. So they invested lots of millions, more than 100 millions, mind you, to migrate into something they call the Z Cloud. So proprietary infrastructure, cloud and hardware, right, to actually address their own user base. In 2015, the project was abandoned and they went back to AWS, and they wasted at least $100 million in this project. Shareholders were mad. I saw on Bloomberg News from back then a lot of backslash that they got, and like, why didn't they just focus on what was making money? Why did they go on infrastructure? So you already see like 2 different sides of the coin, right? Like Snapchat only focused on their money and they got like criticized. Why didn't you invest in infrastructure? Zynga tried, failed, and they got like the critique. Why did you even try? Keep going, like keep doing what you're good at, right? Keep serving the gamers.
It sounds insane that this decision that Zynga did. I suppose it was still early in terms of products on the internet. But I mean, it doesn't make sense to make your own solution for something that already exists, that is quite cheap as well. And you cannot maintain servers on your own if you're just a small mobile game. Like, I remember Farmville. I played it, but it cannot be so server heavy of a game.
And I have the answer to that, right? Like, why didn't it work, right? Because they had the cash. Why didn't it work if they had the user base and they had the cash? And the answer is in Dropbox. I guess like service that we all know, right? You like with their famous drag and drop, one of the first ones. So you just have your own files and storage. So they also saw, this was 2 years prior IPO. So before the initial public offering. They saw how they also were tied in AWS, and they foresaw that if they would have kept going, they would have felt tied like Snapchat. So what they did was they did an internal investigation of, hey, if we put some capital for a portion of the files that we have, how much money can we save? So they didn't do it like massively. They only did it for a portion. And the first year was successful. They saved like over 30 million. So the second year, they migrated 90% of their services and they saved for a total of $76 million. And their margins went from 56% to 76. Like they saved like 20% margins from this move. And this is the thing. Why did it work?
It makes sense for Dropbox. Like their entire business model is storing things. So if they don't own their own storage, why do they even exist? Like
you have it. Yes, you said it perfectly. The problem is always this one is you should own the base, rent the spikes, right? The problem with Dinga was actually not that it didn't have enough user base, but that the user base was seasonal. Right? Since it was a game that you just play when you have some time off, it was mostly weekends, mostly holidays, and mostly the summer. So during like a normal workday on October or November, I'm not going to say they didn't have user base, but they had it so low that they were burning money on having their own infrastructure. But Dropbox model, because you pay every month the same amount. I mean, I personally don't move my files from the cloud that often, right?
no, not on a monthly or weekly, daily basis.
No, like if they're there, they're there. Like if you have the
Yeah.
pictures of your wedding or something like that, they're going to stay there for a long time. So Dropbox understood this, or maybe it was an afterthought. But by owning the base, and because they have such a repeatable user base and user payment base, they could actually save a lot of money. But they're still renting the spikes. Even Dropbox has some spikes. Like perhaps when users during the holidays, they just upload their videos or their latest discoveries. So they still use AWS for the spikes, and then they migrate the stability into their own infrastructure. So overall, I think Mark Anderson said it, own the base, rent the spike. That's what Snapchat should have done. So the suggestion to avoid the 2 billion trap and avoid the infrastructure trap is a couple of years or 1 year before IPO, when you still are not on the public market with scrutinization from the New York Times, not the least, is check if you have stability over your payments. And if you do, put it into your own infrastructure. And second, of course, check if you have the knowledge, right? And if you can maintain it in the long term. And third, still run the spike, right? And then do it as a Dropbox, do it in layers. Start with something small and then you expand. You run like a case study internally. That's how Dropbox saw it that was successful.
So this AI company then, what was it called?
Mistral.
Mistral. So Mistral, what do you think they're making a good move now?
Yes, I think it's already an amazing move because they are not IPO'd yet. So maybe this is a move towards the IPO. If they succeed, I mean, is our chat? I don't know personally if chatbots are daily use, weekly use, monthly, like how seasonal they are, but it seems to me they're fairly solid. Like, I mean, companies are using chatbots, APIs in a stable way. So if they're stable enough, it's an amazing move, right? They're investing in their cloud, in a data set, in infrastructure, even in designing their own microchips. And they can keep renting spikes from NVIDIA, right? They can keep buying spikes. So I think it's a great move. I support it. If I could, I would buy the Mistral stock today.
Yeah, right. Yeah, that's really interesting. And it makes sense, right? So AI, the business is computing things. So you need a place to compute. It's like a really operational heavy product. So it makes sense that you want to own your own servers to some extent compared to just a small mobile game. That's not the product. You're selling the experience of playing a game, but that's not necessarily a heavy operation. And maybe even each user has the game installed on their phone.
Yeah. So basically to the startup out there, right? Maybe they're early stage or they're on a scale up. Is do not invest in infra until you're kind of in an IPO area.
Yeah.
Right. Even Mistral, like, I mean, they're still in the billions, right? They basically were a unicorn the day after they got founded. And they still waited 3 years, 3.5 years before they invested in infrastructure. They still got to 1 billion revenue before that. So until you're like in the vision of an IPO, do not invest in infrastructure. And then if you want to invest in infrastructure, do it like Dropbox. You start with something small, like a 10% of your department. Maybe just start with the marketing department or a specific user base, and then you extend it all over the base. And remember, own the base, rent the spike. I have a LinkedIn nugget for you. This came to my feed this morning. The sentence, if you're not working 7 days a week, nights in the office, you're going to lose.
Oh, wow.
First reaction.
you know what my point of view is on this, because I think creating a startup, it's a marathon and not a sprint. What do you think?
Okay, so I'm gonna try to come with the data first.
Yeah.
Okay, so this one is, I did not do backup research on the founders. The startup is called Corgi Insurance, and they're already worth like around $4 to $6 billion in 2 years. And one of the VCs that invested did like an analysis, so we want to call it, and keep saying that there is no founder that founded a startup which is worth at least $5 billion who didn't work almost 7 days a week.
Okay.
Now, having this said, I still believe it's a marathon, not a sprint,
Yeah.
right? Because the unicorn is a unicorn, right? It's rare. So the thing is 99% will still work 7 days a week for scraps.
Yeah.
Don't burn out yourself. Don't gas out.
I mean, I don't know. To me, it would be physically impossible. It's just not in my nature to. It's not in my nature to work now, but I mean, I need rest. I can work 8 hours, a normal workday, and be really focused, but I need to rest. I need to do walks and training and eat properly, meet friends. So to me, it just wouldn't be possible.
Yeah.
So, I mean, I can't believe in it because then I would not believe in myself. I think a lot of startup companies that have this in mind, the 7 days a week, they burn out. And there's nothing more annoying than being in a startup with somebody that overworks themselves because all of a sudden they disappear for a couple of months because they're burnt out. They cannot do anything. And yeah, who cares if they worked 7 days a week during that moment in time? Now you can't trust them to be there every day of the week, you know? And yes, if it was necessary, I would come in on a Saturday and a Sunday. But if it's not necessary, I don't see the point.
Is, of course, big ifs. But if you're an early stage startup and you're closing the deal of your life, it can be any VC investment round, it can be that client, right? They're like, oh my God, if I close this deal, I'm going to have 2 years of runway. Sure, for that month, go work 7 days a week, right?
Absolutely.
It might make the difference that month. And then I also believe in survivor bias, meaning some of these personalities that like are workaholic, they also come from a high achievement, high performing past. So they would have raised that round regardless. They would have closed that deal regardless, but they attribute their success to the relentless work. That in part, maybe it's true, but I believe that like lovable would still be lovable if Anton, the founder, is not working 7 days a week. Right. Now, I don't know how much he works, but I know he's a fan of 996, then from 9 in the morning to 9 in the evening, 6 days a week.
Okay.
Similar.
Okay.
So it's 12 hours a day,
Yeah.
6 days a week.
Yeah.
It's fairly a lot.
Well, I mean, if you really love what you do, and I mean, it's kind of like a hobby, I guess it wouldn't hurt you to work that much, but I wouldn't force myself to do it. I don't think that's helpful to really push it. If you're tired and you're bored of what you're doing currently, take a break and do something else.
Yeah, take a break or you will break.
Yeah, exactly. But that's what I think. But Lovable, isn't his brother an investor as well?
I have no idea. But I know he was the first engineer at Sona, and there was an exit of $1 billion. I hope for him he had stocks, so probably he was well off, if not financially dependent, way before Lovable. So also, there is also that one, like when you're building something, not for the money, for the mission, you might maybe be even more eager to like jump at the task. If you know that, well, you still go home to you're not going to have a problem with mortgage or with, will at the end of the month, I pay my expenses. If you don't have that occupying your mind, you might have already some extra leeway.
Also, these people you're talking about, maybe they have help with cooking and cleaning and
I hope.
this kind of thing. But if you are a first-time founder, actually, you have to be a really good cook because you can't go out to a restaurant. You can't do any of these kind of things. So I don't know. Maybe, as you say, some of them have contacts that help them.
Also, I hope that no one would give away their health for just that 10% extra in revenue. Even if you're putting down your whole 100%, you would close that deal. Maybe it's not worth it in front of your family.
So we don't believe in it.
I would say I believe partially in it. I cannot ignore the stat of there is no one in the 5 billion club that is not working like this. Right. So I cannot ignore that stat. So I'm not going to say, no, it's stupid, doesn't work only 40 hours, be full employee. I mean, you're still a founder. You're still going to watch your phone if you're closing a deal with, I don't know, Oracle, right? A 2 million euro deal Oracle. You're going to still be there in the room. You're going to still be tense, but take care of you is always the top priority. Now,
Okay, I'll
how
work
many
better.
fail out of those that try?
I don't want to work that much. Okay, so we have this question from a listener called Ida. And she has this company that they have a certain product that they sell per seat. They have a certain business model, but now they have this other company, a huge organization that wants to buy a corporate solution, a specialized solution for their product, which is not part of their offering. So her question is, should she take that on? Because it's a chunk of money, but it doesn't go with their revenue model.
Always take the chunk of money. This reminds me of a question we got with a startup. So they also had SaaS subscription model. They were charging students and schools, so selling to universities, colleges, and higher educational systems. So they had like plenty of customers, they were going well. But then one university asked them something similar, like said, hey, we do not care about your SaaS. We do not want license-based. We want access to your API, right? He showed the system and there was like the API, right? That is basically an interface to your backend. And they're like, yes, we want that. We want that backend. We want to integrate with it. And that was not something he ever sold, right? So it was the question of, should I? Should I not?
I mean, if they want to spend money, why not say yes? Like, it sounds like a easy yes to me, right?
And it was not an easy yes, meaning it's easy to say yes to everything, right? Because money is money. But first, he is still a SaaS subscription model and he has investors. Investors invested in the SaaS business. This one is slightly different. An API business is a completely different business, right? They did not invest in the API business. So already there might be some legal aspects. So first, depending on the contract, you might need some clearance from the investors. The second part is the pricing. Like, okay, SaaS seats, they seem easier. Like you just say, okay, how many seats? 70, 80, and then you might apply a discount. So easy. Quotations. API, completely different model. In this case, he would have an API key. So there are no seats. They did not want to pay per usage because they were enterprise. They wanted to know exactly how much to pay. They just said, give us the number and we pay it, at least for 1 year. So it was not even sure if it was recurrent. And what we did is we sit down on, okay, how do you then calculate the price? Given you take this business model, how do you calculate the price? And since his solution was not increasing revenue, I mean, it's an educational system, so we went on costs. So this API would have saved, or better, to build this API, to build this solution, the university would have to invest in 3 full-time developers, maintenance, and at least a couple of servers. So we put together that cost, right? And back then was around 3, if I remember correctly, 3 to 4 developers full-time. It was the server's cost and the maintenance costs. And putting all together was something around 300,000 euros. And then what we applied on top of it was 150% ROI. So something around, what was it? 100, now I'm going on top of my head, but like maybe 200,000 euros or 150,000 euros, something like that. And that worked, right? Because pricing was based on logic, right? It clearly said, here's the solution if you want to build it yourself. Mine is already here, active and cheaper. And the investment opportunity for him, the founder, was, okay, I invest another 100 euros in an extra server. I replicate the API and I have it. Yeah. And then he got that cash in. Though that cash was not counted in his revenue projections with investors because it was not recurring. It was a una tantum, right? It was just that payment. No guarantee of next year they're going to pay again. So almost like a consultancy business. So as long as you know this too.
150,000 in runway is really good though. So if with a little bit of investment from his side, it makes so much sense to take that deal.
Yeah, exactly. And this is what I'm saying with always, yeah, but does it make sense for everyone?
Yeah.
Like again, his case was he already had the API. It was the same API he used for production. He already had different keys because of his own developers and things. He just needed to give a key and an extra server. Super simple. Now, for Ida, these are the questions. Would it be that simple, the setup? How much money, time, and investment would take her, right, to just have all the setup? And also, if it is not recurring, is she okay to not count it in revenue for the investment?
And then in order to know what price to offer, you want your customer to get 150% ROI compared to if they would build it themselves.
We tested that empirically.
And that chunk of money that she would get in should be significantly higher than how much effort she would have to put into fixing this solution.
Yeah.
So, and maybe, I don't know, is it a good idea to look, if one customer wants this kind of solution, maybe more customers would be interesting.
I mean, in our first startup, it opened up a Pandora box of basically never settling down on a specific business model. So I would always avoid that, like try to, like don't keep looking for gold, right? Like maybe you have it, just nurture it a bit more. But I mean, keep your ears open and eyes peeled. If this is an opportunity where every time you just invest 100 euros, like in this case, or like say like 200 for like an overhead, you get like 150 to 200,000 euros in. I mean, it's an easy yes. It's like what, 99% margins. But yeah, is fine with your own founders. Does even this make sense? And if you have good advisors and good investors on board, so that they really care about your mission, vision, and long term, keep them involved in the decision making. You should not be alone.
Thank you for listening to the Two Founders podcast.